why hasn't peak inflation led to peak Fed hawkishness? Headline CPI inflation has been moderating since it hit a peak in June, and yet the Fed has stepped up its hawkish tightening commentary in a meaningful way. This is because the source of higher inflation has shifted materially in recent months, and it speaks to the Fed's sticky inflation problem. In the early days of the pandemic recovery, high inflation was driven by skyrocketing goods prices. Lockdown sparked a big surge in goods demand, but also disrupted supply chains. This combination led to a surge in the prices for durable goods, like cars and furniture. At their peak at the beginning of 2022, durable goods prices were rising over 18% year over year. Now supply chains are healing, shipping costs are falling, goods demand is moderating, and goods inflation is falling quickly. It's now running at just under 8%. But now the source of higher inflation has shifted. The August CPI report showed an acceleration in services inflation. Services are a larger component of inflation than durable goods, and this inflation tends to be stickier, meaning that it is not as volatile, so when it goes high, it tends to stay high for longer. The source of this stickiness is wages. Wage growth fuels services inflation. And with a very tight labor market, wages are growing at 6.7%, their fastest pace on record going back to the mid-90s. This creates a challenge for the Fed in their fight against inflation, as they are acknowledging that they will likely have to see a looser labor market, meaning higher unemployment, in order to cool wage inflation, which will be necessary to cool services inflation. This sticky inflation problem likely keeps the Fed tighter for longer, even if we see headline CPI continue to moderate.